Hello guys, welcome back to our channel, the best finance channel on YouTube. If you enjoy watching, please hit the subscribe button and the notification bell so you won't miss out. Obtaining capital or money for any form of spending is known as finance. In order to finance their operations, consumers, businesses, and governments frequently lack the cash on hand to spend, settle debt, or carry out other activities. As a result, they must borrow money or sell shares. On the other side, investors and savers build up money that, if used wisely, could provide interest or dividends. When these savings are lent out at interest or invested in equity shares, they can be used as a source of investment money. These savings may accrue as savings deposits, savings and loan shares, pension and insurance claims, or any combination of these. Stocks finance is the acquisition of capital or funds for any type of expenditure. Consumers, corporations, and governments frequently don't have enough cash on hand to make purchases, pay off debt, or perform other tasks because they need to support their operations. As a result, they are forced to sell shares or borrow money. On the other hand, savers and investors accumulate funds that, if invested effectively, may yield dividends or interest. These savings can be used as a source of investment capital when they are lent out with interest or put into equity shares. Savings deposits, shares of savings and loans, pension and insurance claims, or any combination of these, may be how these savings accumulate. There are two sorts of stocks, ordinary and preferred. The distinction is that whereas the owner of the former can exercise voting rights in company decisions, the latter does not. However, before any dividends are paid to other shareholders, preferred shareholders have a legal right to a specific amount of dividend payments. Additionally, there is a thing known as convertible preferred stock. Essentially, this is a preferred stock with the option to convert at any point after a set date into a predetermined number of common shares. How do people buy stocks? You can quickly purchase stocks on the broker's website after creating and financing your account. Other choices include purchasing shares directly from the business or utilizing a full-service stockbroker. It's just as simple to open an online brokerage account as it is to open a bank account. You must fill out an account application, present identification, and decide whether to fund the account electronically or by mailing a check. Examine the stocks you want to purchase. The process of choosing stocks can begin once your brokerage account has been created and funded. Investigating businesses you are already familiar with from past customer interactions is an excellent place to start. Avoid becoming overwhelmed by the flood of data and real-time market gyrations while you perform your study. Keep your goal straightforward. You are looking for businesses that you would like to invest in. Buy into a firm because you want to own it, not because you want the stock to go up, famously said Warren Buffett. By adhering to that principle, he has achieved fairly well for himself. Choose how many shares to purchase. There should be no pressure placed on you to purchase a specific quantity of shares or to include a stock in your whole portfolio at once. To get your feet wet, think about beginning with paper trading utilizing a stock market simulator. Paper trading allows you to practice buying and selling stocks using fake money. Or you can start small, really tiny, if you're willing to invest actual money. You may buy just one share to get a sense of what it's like to own individual equities and to determine whether you have the stamina to weather the tough times with little loss of sleep. As you develop your shareholder swagger, you may gradually increase your position. What is dividend? A dividend is a payment made by a corporation to its shareholders that is decided by the board of directors. Dividend payments are frequently made quarterly and might take the form of cash payments or stock reinvestments. The dividend yield, which is the dividend per share, is stated as a percentage of the share price of a corporation, for example, 2.5%. If a common shareholder of a dividend-paying company owns the shares on the ex-dividend date or earlier, they are eligible to receive a payment. A quick reminder, before we further continue our video, if you've enjoyed the video so far, consider subscribing, as we frequently upload such informative and educational videos. Let's continue. Changes in stock prices. The forces of the market affect stock values every day. This refers to the idea that supply and demand affect share prices. A stock's price rises if there is a greater demand than supply for it. If there was a bigger supply than there was a demand for a stock, the price would drop. It's simple to comprehend supply and demand. What makes individuals like one stock and dislike another stock is tough to understand. The key is to distinguish between news that is good for a company and news that is bad. There are several solutions to this issue, and almost every investor has their own approach. The main theory is that a stock's price changes reflect what market participants believe a company is worth. Don't mistake the value of a firm for its stock price. A company's market capitalization, or the sum of its stock price and the number of outstanding shares, is what determines how much it is worth. For instance, a firm with 1 million shares outstanding that trades at $100 has a lower value than a company with 5 million shares outstanding that trades at $50. $100 x 1 million equals $100 million, while $50 x 5 million equals $250 million. This reflects both the current value of the company and the future growth that investors anticipate, further complicating matters. Stock market. The term stock market refers to a variety of locations where investors of companies are publicly traded. Such monetary dealings happen on recognized exchanges and in over-the-counter markets that follow a predetermined set of regulations. The terms stock exchange and stock market are frequently used interchangeably. This makes up the broader stock market. Traders purchase and sell shares of stock. Short trading. Rising stock prices are profitable for many savvy traders. However, some people use a technique known as short trading to achieve the exact opposite, earning from equities that lose value. Short trading is borrowing securities from your brokerage whose price you anticipate falling. Your strategy is to later purchase the same stock, preferably at a discount from the price you originally kept the difference after paying back the initial loan. Consider a stock that is now trading at $50 per share. 100 shares that you borrowed are sold for $5,000. You earn $2,500 by buying the ones you borrowed when the price abruptly drops. How to invest actively passively in the stock market. A portfolio manager or other active participant is often required to take an active role in active investing. Less buying and selling is involved with passive investing, which frequently leads to investors purchasing index funds or other mutual funds. Both investing strategies have advantages, but passive investments have attracted larger investment flows than active investments. In the past, passive investments have produced higher returns than active ones. More people are engaging in active investing now than they have in a number of years, particularly amid market turbulence. This channel has all the capacity and intellectual strength to teach you ways and methods of financial services and the ways they are made. Hope you enjoyed our video and learned something about money today. Make sure to subscribe and share the video if you liked it. Thanks for watching. So, did you find this video informative? Please share your views with us in the comments section below. We would love to read them. Till next time.